Good afternoon, everyone. I hope you can all hear me and see me clearly. I'm just going to give it a quick minute or two. I see that, thank you to everyone who's joined a bit early. I'm just going to give it another 30 seconds to 1 minute. I know that some people are trying to log in still. So I'm just going to give everyone a moment to get set and ready. In the meantime, feel free to say hello in the Q&A section. You're more than welcome to post questions as we go in there. At the end, we'll try to get through some questions, time dependent, but of course, we can always address them directly afterwards. So I'm just going to give it another possibly 1 minute, just to let everyone settle, and then we'll start. I see we have people from many different parts joining today, which is great to see. Looks like, well, welcome everyone. I'm not going to say names, but we have people on from Zimbabwe, Egypt, Kenya, Tanzania, Nigeria. It's fantastic to see. Hope everyone's getting ready for a great long weekend. 30 seconds to go and then we'll get started. Okay. Everyone, I'm going to get started. I know some people are joining a little bit late, but I need to be fair for everyone who's joined a little bit early and on time. So without further ado, I suppose good afternoon from my side in Mauritius, or good morning from where you may be, depending on where you are in the world. If you don't know me, my name is Jared Jacklin, and on behalf of Carrick Catalyst, I just want to start by saying thank you, genuinely, for giving us your time today. In a world where everyone is competing for your attention, I don't take that lightly. So I'm going to make sure that this is worthwhile for you. Now, I want to start today not with a pitch or with a product, but with a statistic. Fewer than 5% of people globally will ever achieve true financial independence. Let's let that one just sit for a second. That means that 95 out of every 100 people who have worked hard, people who have earned good income, people who have had every intention of building a secure future, will retire either dependent on family, dependent on the state, or simply unable to stop working. Not because they didn't earn enough, and not because they weren't smart enough, but because they never had the right strategy at the right time. And that distinction, the right strategy at the right time, is exactly what today is about. Before I go any further, let me just spend 10 seconds telling you just exactly who we are at Carrick Catalyst, because I think it's important context for everything that we're going to hear today. We are the offshore investment specialists. That is our lane, and it's where we operate with conviction. Now, when people hear the word offshore, they sometimes think it's only for the ultra wealthy, or that it's somehow complicated or out of reach. And I want to dispel that completely. Offshore investing is one of the most powerful and practical tools available to any serious investor. And here's why. When you invest offshore, you invest in hard currency. US dollars, British pounds, euros, currencies that are stable and globally recognized, and also hold their value over time. For anyone living and earning in an emerging market, where local currencies can be volatile or unpredictable, this is not a luxury, it's a necessity. And think about what inflation does to your purchasing power at home. The cost of living arises, your currency weakens, the value of local savings quietly erodes, and often without us even noticing. Offshore investing is one of the most effective hedges against exactly that. And then there's, of course, the question of market security. The markets we work in, Mauritius, the UK, Jersey, Guernsey, Isle of Man, I can go on, but other established international property and financial markets are tried, tested, and regulated to ensure a standard that that provides investors with the level of protection and track record that many local markets just simply cannot match. These are markets with decades of data, legal frameworks that protect investors and performance histories that you can actually rely on. So when Tony and Will speak to you today about UK property and capital appreciation and international income strategies, understand that this isn't about chasing a better return. It's about building wealth in a currency that works for you, in markets that have proven themselves, with a layer of security and stability that gives your future the foundation it deserves. That is the difference here at Carrick Catalyst, and it is the lens through which I encourage you to watch everything today. Now, we've called this debate, or this webinar, sorry, the investor debate. Capital appreciation versus income generation. Two strategies, one market. And on the surface, it sounds like we're going to put them against each other and then declare a winner. But I want to challenge that framing right from the start, because by the time we wrap up today, I think you're going to see something that most investors never fully grasp. It was never really a debate, it's a sequence. The real question has never been which strategy is better. The real question is which strategy is right for you and where you are right now. And do you actually know the answer to that? So today we have two world-class partners joining us. I'll introduce shortly. Tony Jordan, Regional Director at API, who is going to speak about the power of capital appreciation, specifically with his example around off-plan property developments in the UK and other parts of the world, and what that looks like in practice. And Will Bailey, Managing Director at Bailey Capital, who's going to walk us through income-focused strategies and where they genuinely fit into a wealth-building plan. They're going to introduce themselves, and then later we're going to go into some specific examples and what that looks like in practice. Two experts, two strategies, and I'm going to let them speak for themselves. But before I do, I just want to plant one idea in your mind that I'd like you to hold on to throughout everything you hear today as well. And here it is. You cannot generate an income from nothing. It sounds almost too simple when you say it out loud, but you'd be amazed and genuinely amazed at how often I sit across from someone or jump on a call with a client and they say to me, Jared, I want to start investing and I wanted to give me an income straight away. And I have to ask them, income on what? And income of what size? Let me give you a real life illustration. If you're saving $1,000 a month, which is a meaningful commitment for most people, and you want that money to generate income for you immediately, and let's just assume a 5%, just for argument's sake, return. Do you know what income you'd be generating in month one? $50. $50 a month. That's not financial freedom. That I would call financial frustration. But here's what changes. Take that same discipline, that same $1,000 a month as an example, and channel it into capital appreciation. Let it compound and let time do the heavy lifting. Over 20 years, for example, you aren't looking at $50 a month anymore. You're looking at an asset base that can genuinely and meaningfully change your life. Now the income conversation gets even more exciting. So that's the journey that we're mapping out to today. I promise you, by the end of this, you will think differently about your own investment strategy. So to start off, I'm going to introduce, or let Tony Jordan introduce himself very briefly. I'll build on what he's talking about, and he will build on more about it later as we go. I just want Tony to introduce himself and where API fits into the market as one capital appreciation example. So I'm just going to bring this up quickly.
Good afternoon, everybody, and welcome along to the debate, capital appreciation versus income. My name is Tony Jordan. I'm the Regional Director for API Global. Firstly, a big thank you to Jared and the team at Carrick Catalyst for inviting me along this afternoon. Now, more importantly, what we do as a business and what we offer an investor. Well, we have a 10-stage step that we follow religiously because every client that we talk to reference a property investment in any of the markets we cover, we take very seriously. From the market research and due diligence we do, identifying city, an area of that city that's going to give capital appreciation over a long period of time, and equally an income from a tenant that will guarantee an income for an investor on a monthly basis or on a mortgage basis, cover the mortgage the service charge and the management fee. The investment advice comes from an industry professional like myself who has been in the property business for 22 years. We also have an FCA regulated mortgage business within API Global that offers clients the access to mortgage finance from 82 different lenders. We have a team of 6 or 7 different solicitors that we use in the different markets that we operate, representing the buyer with the developers' solicitors. We send construction updates on a quarterly basis. We have ready property. We have property that's 3 months away, 6 months, a year away, or even up to 2 years off plan residential property investments. We also offer golden visas in the UAE. Obviously, with the conflict that is going on currently, this is the market that we are still actively in. One of our major offices is based in Dubai, but we are looking and working with developers currently on the ground to bring new projects when the war settles down. One of the biggest strings to our bow is the lettings management business. We have a company in the UK that manages over 1,500 properties for our clients. Now, they do everything from sourcing the tenant, doing the snagging with the developer, collecting the keys. All our investors globally do not need to be in whichever market that investor is investing into. They will collect the keys, they will furnish the apartment if needed, they will put the tenant in, then on a monthly basis, they will collect the rent, pay the bills, and send the return to the nominated bank where the mortgage finance normally comes out of. Portfolio optimization is one of the new factors we brought into the business. This is AI driven. So when a client has a property, they have access to a new online portal that will optimize their portfolio, whether that's 1, 2, 3 properties. Is it the right time to sell? Is it the right time to hold? Or is it simply that we can draw some equity out of that asset that the client owns to put down on a future project?
There we go. So I know that was introductory, just that will become very, very clear where we go shortly when we talk about capital appreciation and in Tony's world, what that looks like on the UK property market side of things as one example. So thank you for that, Tony. And just to build on what you've just heard, everyone, because I think it's important to connect Tony's world to something that feels very real and very tangible for all of us. I know that some of you might be thinking, off-plan property, UK developments, capital appreciation, that sounds like something for people who have already accrued significant wealth, people who've already made it. And I want to flip that thinking completely, because capital appreciation is not the strategy for people who already have wealth. It's the strategy for people who are building it. And here's something I'd like you to remember. The most powerful force in investing is not a high yield product. It's not a hot market tip, and it's not even the asset class that you choose. It's time and it's compounding. There's a principle called the rule of 72. It's simple, but it's one of the most powerful ideas in personal finance. You take the number 72, you divide it by your annual rate of return, and that tells you how many years it takes to double your money. At 8% annual growth, which is a realistic long-term benchmark, your money doubles every 9 years. So let me paint you the picture. You're 35 years old and you invest today. By the time you're 44, your money has doubled. By the time you're 53, it's doubled again. By the time you're 62, before you've even hit traditional retirement age, it's doubled a third time. That is 8 times your original investment without adding another cent after today. 8 times. Now imagine you're not just investing a lump sum, imagine you're constantly adding to that pot every single month also. The numbers then become extraordinary. And that right there is why the capital appreciation conversation, the growth conversation, is the most urgent one for the majority of people watching today. It's not always glamorous. It doesn't give you a monthly income statement that you can look at and feel good about, but it builds something real, something substantial, and something that further down the line makes every other strategy possible. And remember, we're doing this in hard currency, in tried and tested markets. So while your money is compounding, it's also being protected from currency erosion and inflation pressures that can quietly undermine even the best local investment strategies. That's why the offshore advantage is working in the background every single day. This brings me perfectly to Will Bailey, because what Will is about to show you is exactly what further down the line can look like. And I want you to listen carefully because the income strategy is powerful. It's just that its power depends entirely on something we're going to talk about on the other side. So let me bring up Will very quickly. He's going to introduce his side of things.
Hi, my name's Will Bailey. I'm the Managing Director of Bailey Capital, and today I'm going to talk to you about investing for income in UK supported housing. So our team's been operating in the market for some time now. Some of our team have been operating in supported housing for more than 40 years. And collectively, we've developed and sold thousands of social and supported housing properties, investing hundreds of millions into the space. And ultimately, we're incredibly passionate about this because not only do our investments deliver a sustainable income for people like me and you, but they also make a great difference to society. What is supported housing and how does it pay you income? Ultimately, the UK is in a housing crisis. We have more people that need housing than we have housing to put them in. And because the government doesn't have a solution with their own housing to look after these people, they have to find another way, and that's where we come in. Now, some of these people will need care and support because of some particular vulnerability that they have, as well as housing. So they may have a physical or a learning difficulty. They may have been made homeless or fallen into drug and alcohol abuse, for example. And the government also funds the care, support and supervision of these people through this model also. Our general offer to the UK government is that we will provide you a better solution to the housing crisis than you're otherwise able to get, with better quality properties at less cost. We make sure this is set up in a fair way so that the income is sustainable for you, but that it's also better because it's a cost saving for the UK government and also for the taxpayer. So it should be a win-win if it's set up right. Now, we've calculated this by doing some research, and the cost to the UK at the moment of a homeless person is over £100,000 a year. That's in terms of temporary accommodation, police, ambulance, all those services added up. It's quite a hefty bill. Our solution, looking at the properties that we have up and running at the moment, particularly in the northwest of England, is less than a fifth of that. So we can deliver properties that look like the ones on this picture here, these are two of our live properties, to the UK government, and we can provide them a solution to their housing crisis that saves them an absolute fortune overall. So it really is a win-win, and that's a very big key in the setup process that means it's going to be sustainable for you and continue to pay you income for the duration of your investment. So, how do you get paid? The UK government funds the housing and care of the people that I mentioned before, the tenants that they need to look after. And they fund this by putting in place regulated housing associations to look after this process. So the housing association collects the rent from the UK government, which is funded by housing benefits. So it's a central government pot of cash that pays this bill. It comes from the UK government to the housing association, and then to the care company. They get paid for looking after the people in your property. And then ultimately the rent goes to you. So the structure here is that you will receive UK government sourced income for providing accommodation for supported housing in the UK, and ultimately be paid indirectly by the UK government. That makes it safe for you, it makes it predictable because we're providing a solution, and it also means that we're doing good at the same time as making some income. So why invest for income? We believe that investing for income is a very sensible part of anyone's investment portfolio. Alongside investing for capital growth, investing in income gives you a few things. Firstly, it gives you predictability, peace of mind. When you invest with us, you can be sure that once the income starts, you're going to be paid on the first of the month every single month for the duration of your lease on this property. The income is sustainable. Income on our properties is contractually agreed for 15 to 25 years, and there are no void periods throughout this, so you can be sure no matter what happens, you are going to get paid. We set these up in a hassle-free way, so it's entirely hands-free for you. You'll never have to do any tenant management, any maintenance. No one's going to call you about a boiler in the middle of the night. This is all going to run in the background. It's passed on to the company that's looking after your property, and you're going to get paid every single month. We also find that inflation is one of the biggest risks to our wealth. It can really make a big difference if you set it up wrong or right, and can erode your capital or otherwise. So we set up the rent in these properties to make sure that it goes up in line with inflation every single year, meaning that your buying power of your income is not being eroded as it would be otherwise. And lastly, outside of the income, not only are you receiving a predictable income, but your capital is also protected, Because in this example you are investing in a physical UK property, you have that ultimate protection of owning the asset. So not only are you buying a 15 to 25 year government sourced income that's predictable, hassle-free, reliable and sustainable, you're also owning a UK property that protects your capital at the same time. And that's why we think this is an excellent solution to wealth building, wealth preservation, and ultimately delivering you a reliable and predictable income.
Thank you, Will, and I'm sure we can all see the appeal. Predictable returns, passive income, cash flow from day one is the ultimate message there. Excuse me. If you've been investing for a while and you've built up meaningful assets, that picture Will just painted is extremely exciting. But I also want to do something now that I think is more valuable than just telling you both strategies are great. And I want to ask you a question that I'd encourage you to answer privately and truthfully. Do you currently have enough assets for that income to actually mean something? Because here's the reality, and this is pure maths and there's no opinion here. If you have $1 million invested at 5% yield, that's $50,000 a year in passive income. That's life-changing. That's the kind of number that gives you options and gives you freedom and gives you choices. But if you have $50,000 invested at 5%, that's $2,500 a year, just over $200 a month. Same strategy, same yield, but a completely different outcome because the asset base is different. The income strategy doesn't change. The yield doesn't change. What changes is the foundation underneath it. And if the foundation isn't there yet, if you haven't built it, then chasing income now is actually costing you the very freedom you're trying to create. And this is the conversation I have with clients more than almost any other. And it's the reason I believe so strongly that before anyone talks to you about what your money can earn today, someone needs to sit down with you and ask, where are you trying to get to? What does financial freedom actually look like for you? And what's going to get you there the fastest, given exactly where you are right now? Because the answer to those questions changes everything. It changes which strategy you prioritize, which partners you work with, and it changes the timeline you're working to. Now, we're going to go a layer deeper with both Tony and Will. We're going to move from the overview to the real. Tony's going to walk us through some examples of what capital appreciation numbers look like from his UK property development off-plan side of things for capital appreciation. And Will is going to show us a social housing opportunity through Bailey Capital. Same, the ROI, the structure, what realistic passive income looks like when the conditions are right. This is where theory stops being theory and becomes something you can actually picture for yourself. Just before I share these next two examples, I'm sure that some questions will come through during this. Just a reminder, please feel free to put questions in the Q&A box. If we can't address all of them at the end of this, some were already pre-asked, which we'll go through at the end also. We'll certainly address them on a one-to-one basis afterwards. So please feel free to put them in. We're going to start with Tony on capital appreciation in the UK property market in this example.
Why the UK? Well, out of the 4 markets that we operate in, this market we've operated in for 13 years. We have a fantastic relationship with the developers on the ground. The investment team from the UK are based in Manchester and London, so they work on a daily and weekly basis with the developers, deliver the safest, most productive property investments anywhere globally. So just to cap on not only the UK, we are quite heavily involved with developers in the United Arab Emirates, which at the moment consists of Dubai and Abu Dhabi. As mentioned earlier, for obvious reasons, it is on hold, not forgotten about, and certainly, having spent 20 years in Dubai, will certainly bounce back. And we're hoping to bring some below market investments for our clients looking to invest in the Middle East, with also that option of a residency visa attached with it. We have a fantastic project in Phuket in Thailand, and we will be bringing more. Sadara Residence is grade A investment class property. The guys from head office and senior management are actually in Thailand now, looking at the development, getting footage for our socials, but there will be different projects coming from Phuket and different parts of Thailand. And then last but not least, we have a fantastic villa project, 10 individual villas, 3-bedroomed with a pool in a gated community for those clients looking at the short-term rental market to deliver double-digit net returns. And then just finally, the last few slides to actually talk about what we go into, what we look at, and really testament to the investment team for delivering the projects in the locations. Now, looking at the Manchester rental market and capital appreciation, you can see that we focus with our projects more on the prime market. The average price growth across the UK is at 1.6%, but you can see from the prime side of the market, 2 bedrooms are returning just under 10% in capital appreciation, and then obviously fantastic figures on the 2 bedrooms from a rental perspective, and this isn't on an annual basis. And finally, just to really give you some case studies. Now, this is with one of our preferred developers, Salboy in Manchester, we've worked with for numerous years. And as you can see from a period starting in 2019 through to 2022, these are projects that Salboy acquired the land, built the project out, we sold it, and now they're fully managed by our management team. And you can see across that period of time what the launch prices was, starting at £160,000 up to viaducts, which we launched at £347,000, now currently valued at £420,000. So we've given fantastic capital appreciation with tenants in, with a rental income. Some clients want that rental income to subsidise any investments they may have as an income, but more so using that leverage finance. Property as an asset class is one of many, but it really is the only investment that you can do, that you can leverage 70% of that investment through mortgage finance, which will cover your mortgage, your management fee, and your service charge, and then give you a cash flow.
Oh, I think it cut short there briefly, but a lot of things to think about there. I'm going to jump straight into the next one, where Will is going to give an example on the social housing income side of things.
I'm going to talk to you now about how it works and then show you a bit of an example of a specific property and the income that you would make if you bought that particular property. So ultimately our job is to buy and hunt down unloved vacant properties, and some of them look like this. They're in a bad state of disrepair and they're bad for the community. So we know if we buy them, we can make a real big impact to the community and the government's going to be happy with our solution. What we do is we buy them and we turn them into warm, robust and safe homes that look just like this. We also furnish them for the tenants as well. So when the tenants move into the property, they've got everything that they need to live a fulfilled and sustainable life and an independent life. And ultimately that means that the government is doing a good job by providing them housing. We're helping and everyone wins, which is the whole point. As you'll see, they look reasonably basic, but generally very good. And that's the key. What does this mean for you and your investment? So here's some rough numbers as to what the properties that we develop actually look like and give you some entry-level investments. You can start with around £100,000 to £150,000, and there you're going to earn a net annual yield of between 8 and 9%. If you step it up a little bit, we go to some 3 or 4 bed shared properties. These are slightly bigger and they'll have 3 or 4 people in. They'll all have their own ensuite and their own kitchenette. It's kind of like semi-self-contained living, our shared homes. They really do offer a great solution. There you can invest 150 to 250,000 and you're going to earn between 9 and 9.5% as a return. And if we go a bit higher, we can access slightly higher returns because we've increased the number of people living in these properties and therefore the rent, with 4 to 6 bed shared homes. Again, studio, semi-self-contained living, 250 to 400,000 pounds each, and those are going to generate a return of between 9.5 and 10.5%. So like in most things, the more you invest, the higher the return that is available to you in this space. So here is a live case study of a property that we are mid-development of in the northeast of England at the moment. It's a 5-bedroom, all-en-suite studio, semi-self-contained accommodation, a shared home for people. It's got a big communal space. This particular house is actually 2 properties put into one, so it's huge. It's a really good one, this one. So purchase price, £350,000, and the annual rent that's been agreed is £35,100. Because you're buying this property from us in its finished state, there's no headache for you with renovation cost or any of the headache involved with actually renovating the property. We take all of that hassle out first, so that by the time you buy it, it's income producing and turnkey. So you really don't have to do anything apart from complete the property and collect your income, which gets paid every single month. As I said, there's no management fees either. I mentioned before that the rent goes up in line with inflation each year, and I'll show you on this diagram here in a second how impactful that can be. And this particular property has been agreed on a 25-year fully repairing and insuring lease. What that means is that from the day that you buy it, your rent is contractually agreed to come in every month for the next 25 years. And it also means that you are not responsible for any of the management, maintenance, or anything to do with the property. You are simply the landlord owning the property, and the rent comes to you without you having to do anything else. So I promised I'll show you the inflationary increases. Here's year one, £35,100. We've based this inflationary increase on an average rate of 2% per year, which is conservative, but it will show you the impact that it can really have on your capital and your wealth. By year 10, you'll be earning nearly £42,000 a year for the same property without having to do anything. And by year 25, this is really quite astonishing, you'll be earning nearly £56,500 a year for the same property. That's the impact that setting this up rightly can have. Inflationary increases, predictable income that's sustainable for you and is hands-free, giving you peace of mind. And that's why we believe that investing in supported housing for income is an excellent part of your investment.
2 strategies, 2 experts, and 2 very real specific examples of what investing can look like in practice. And I want to say something before I wrap up, because I think it's important context for everything that you've just seen. What Tony and Will have shared with you today presents 2 examples of what we bring to the table at Carrick Catalyst. 2 strategies out of many. We work with clients right across Africa and beyond, and at every single stage of their wealth journey. And the reason we're able to do that is because we've built relationships with partners who have expertise and genuine solutions across the full spectrum of investing. Capital appreciation and income generation are 2 powerful ones, but they are just the beginning. And underpinning all of it, every strategy, every partner, every recommendation we make is that offshore foundation. Hard currency, regulated markets, tried and tested jurisdictions that have proven themselves over decades. Because building wealth is one thing, but building wealth that is protected, stable, and working in a currency that holds value is something else entirely. And that is what we're here to help you do. So back to let's call it the debate. I hope that what's become clear today is that this was never really a competition for a winner. Capital appreciation and income generation are not actually rivals. They are chapters in the same story. And the most financially successful people I've ever worked with understand that distinction at their core. The ones who struggle, they're usually the ones trying to read chapter 3 before they finish chapter 1. So, to be direct, if you're in your 20s, 30s, or even 40s, and you're still in the phase of building your assets, the single most powerful thing you can do right now is focus on growth. Focus on discipline and capital appreciation. Give compounding the time that it needs to work and build something substantial. Because the income conversation, the truly life-changing, wake up and the money is already working for you kind of conversation, becomes possible once that foundation exists, as you've seen in that example that Will just shared. And if you're at the stage where you've built meaningful assets and you're now thinking about how to make them generate real, consistent, passive income, then Will's world, I'm going to dub that title, Tony's world and Will's world, becomes incredibly relevant to you. And the numbers you've seen are very, very real today. The point is, you also don't need to choose one forever. You need to know which one is right for you now, and that requires clarity. Which brings me to the most important question I want to leave with you today, and sit with this one. Do you know your number? Not a rough idea, not a ballpark, but your actual number. The number that represents true financial freedom for you. The number where your assets are large enough and working hard enough that the income they generate means you never have to work again unless you choose to. And the number that funds the life you actually want to live. Because if that number is not crystal clear for you right now, or if you haven't sat down and mapped it out properly with real figures against real time, then that is exactly where we start. At Carrick, we can show you precisely what that number looks like. We can show you what it's going to take to reach it, and we can map out which strategy or a combination of strategies gets you there fastest. That is the conversation worth having, I think. And if you're ready to have it, we're ready to have it with you. So please reach out after this session. We certainly will. We'll touch on some questions briefly. We've run out of time slightly, but we've got a few minutes. So thank you so much for being here again today. It really, really has been a pleasure. I think we've got time for a quick couple of questions. I see one or two has come here. So the first question, after a period of 15 to 25 years, does the homeowner lose the title to the house? Or is this the time frame only related to the property management by a third party firm? That is in relation to the 15, 25 years with the social housing. Short answer is you do not lose the title to the house. You own the house outright, and you're absolutely right. It is just the lease that is associated with that. That is, of course, then up for renewal. Also, just to touch on that, at any point, you aren't locked in. You can sell the house if you wanted to, and you sell it with a lease. So there are options open to that. Okay. Another question I see has come through, is this going to be recorded? It has been recorded, absolutely. So we will share it to everyone who has registered for the webinar. So you will get this automatically shortly after. Another one, are the properties transferable? I think that feeds into the first question. When you talk about both sides, let's talk about the capital appreciation market that Tony was talking about. You own the property outright, and that's the case with actually both of them, right? So you purchase the property, whether it's on one like Tony was describing, the mortgage attached as well, normal process really applies. So short answer, yes, on both counts. Another one, there was one asked earlier as well. What are the entry levels for these properties? You would have seen some information on that with the social housing starting point about £100,000, £110,000 as an entry level. In the buying off plan capital appreciation market, the property values vary, usually around £180,000 to £200,000 plus. But what's important in that, as Tony highlighted, is that you don't need to purchase it cash. You can use an international mortgage. Him and his team can facilitate that as well. So the deposits required are significantly less than that and can be staggered over time, right? So the entry level for that is usually a little bit lower or can be staggered, okay? One more very brief one. What options are there outside the realm of property for capital appreciation and passive income? Very, very good question, that. I did highlight as well that these are two examples, the property realm for capital appreciation and for passive income. We work very much in the financial market as well here at Carrick. Also, building up assets over time, letting compounding do its job, and then also managing portfolios at the other end of the spectrum when it's time to start using the money and letting the money work for you. Okay. I promised one more last question. Is the full investment required upfront, or are there part payment plans available, and over what duration? So for the social housing, payment upfront. Yeah, it's a cash purchase, and that's why we talk about when you have significant assets, that really starts to make sense, where you can start to get those assets now generating income. From the UK property buy-to-let off-plan model, There are payment plans available, and it does vary on location. For example, the UK is usually staggered over 2 or 3 payments, depends on the development as well, and it depends on their completion times. I know it works a little bit differently in the Dubai market, for example, where after a deposit you can have more frequent payment plans as well. So a number of options are available. Okay. Can you move funds from Africa to invest in the UK? Yes, that's entirely what all of our businesses are built upon. Okay, it's something that we do on a daily basis, so we can absolutely help. Guys, there's been some great questions. I see more questions are coming through. We did say we'd keep this nice and short and sweet as much as possible, but I think I'm the one who spoke a little bit too much. So we will address questions directly straight after this. Any more, please reach out to us as well. Once again, thank you very much for your time. Really looking forward to working with you all a little bit closer, looking forward to more questions. And for those of you who do have it and are celebrating, have a fantastic long weekend. Stay safe and looking forward to the next one. Take care.